Good day. Welcome to FAQ 3704 Group Financial Reporting Module. In this video, we'll be discussing the different types of investments covered in this module and the applicable accounting standards pertaining to each type of investment. Let's jump right into it. There are four different types of investments that we'll explore in this module. We'll explore the simple investment, the subsidiaries, associates, and joint ventures. Simple investments, which are governed by IFRS 9. These investments will include both listed and unlisted equity investments. All equity investments are to be measured at fair value in the statement of financial position. The fair value changes, they are recognized in profit and loss. Please note that the entity has an option. This is an option to elect to recognize the fair value changes in other comprehensive income. However, election is not applicable to equity that is held for trading. This is equity that is held for the short term for speculative purposes. So the option to elect to recognize fair value changes in other comprehensive income is not applicable on equity investments that are held for speculative purposes. Subsidiaries, this is governed by IFRS 10. Subsidiaries are governed by IFRS 10. In a subsidiary scenario, there are two main parties. You get the acquirer, which is commonly known as the parent. This is the entity that obtains control of the acquiree. You also get the acquiree, which is the subsidiary commonly known as the subsidiary. This is the business of businesses which the acquirer obtains control of in a business combination. So what determines this type of business combination is the word control. We'll unpack the word control further in the upcoming slide. This is the word that differentiates a subsidiary-parent relationship from other types of investments. What determines control? So you have three elements that need to be met to determine that control does exist in a parent-subsidiary relationship. These three elements are the following. An investor controls an investee. Only when these three elements are applicable, you need power over the investee. That is very critical. So an investor has power over an investee when it has existing rights that give it the current ability to direct the relevant activities of the investee. That is the first requirement. The second requirement is exposure or rights to variable returns from its involvement with the investee. And the third requirement is the ability to use its power over the investee to affect the amount of returns to which it is exposed. So what is critical about this relationship is the power to control the subsidiary. That is very critical. The third type of investment we'll unpack is investments in associates. So the operative word for investments in associates is significant influence. Remember, for investment in subsidiaries, the operative word there was power and control. With an associate, it is different. There is no power or control. However, there is significant influence, especially regarding major decision making. So we'll unpack the word significant influence further in the upcoming slide. With investments in associates, they are governed by equity accounting. This is IAS 28. IAS 28 has stipulated that initial investment should be recognized at cost. So at acquisition date, you recognize the investment at cost. Thereafter, post-acquisition, you'll make adjustments. So you'll make adjustments for three main things post-acquisition. This will be the retained earnings or accumulated loss post-acquisition. However, it will be post-acquisition excluding the current financial year. And secondly, you'll also make adjustments, profit and loss for the current period, and also the gains and losses that are included in other comprehensive income for the current year. So those are three main factors that you'll need to keep in mind, or the three main adjustments that you'll need to keep in mind after acquisition date. What determines significant influence in order to determine that a relationship consists of an associate? Well, a lot of people will say around 20% of investment will determine an associate relationship. There are formal guidelines whereby there's 4 indicators. One or more of these indicators will determine if there is significant influence. The first one, if you have a representation on the board of directors in the associate company, that could be the first indicator that there is significant influence. The second one is if you participate in policy making processes. Well, this will encompass the decision regarding dividends when they are declared or how much is distributed, and also if there is material transactions between the investing entity and its investee. The fourth one is interchange of managerial personnel or provision of essential technical information. So that will also be an indicator that there is significant influence, meaning that there is indications that an associate relationship is present. The fourth type of investment is a joint arrangement. What is a joint arrangement? A joint arrangement is an agreement of which 2 or more parties have joint control over the investment. A joint arrangement will have the following characteristics. It is not only 50% as a guideline, however, it is parties that are bound by a contractual arrangement. It has to be a formalized contractual arrangement. The parties are bound by a contractual arrangement. The contractual arrangement gives 2 or even more. It can be more than 2 of those parties joint control over the arrangements. There are 2 types of joint arrangements which we'll discuss on the upcoming slide. These types of joint arrangements consist of a joint operation and a joint venture. I'm sure you'll be able to recognize this diagram from your study guide. This is the 501 study guide. With a joint operation, there is a decision tree that you can use as a guideline. The first indication or the first consideration you should think of is, does the legal form of the separate vehicle give the parties right to the assets and obligations for the liabilities relating to the arrangement? If they do, automatically it is considered as a joint operation. So a joint operation will be governed by IFRS 11. If that is not the case, you go to the second decision. Does the terms of the contractual arrangement give the parties rights to the assets and obligations for the liabilities relating to the arrangements? If that is the case, it is a joint operation governed by IFRS 11. If that is not the case, consider the third factor. Do other facts and circumstances give the parties rights to the assets and obligations of the liability relating to the arrangements? If that is the case, again, it is a joint operation which is governed by IFRS 11. If none of the above are applicable, therefore, the arrangement is a joint venture which is governed by IAS 28, and that is the same standard and same methods that you'll use when you apply to associates. So let's put it all together in summary. I'm sure you'll recognize this decision tree from your study guide, your FAC 3704-501 study guide. The first question you'll need to ask yourself, does the company have control, i.e. power, over the investee? If it does, it will be a subsidiary which is consolidated applying IFRS 10. If not, you'll need to ask yourself, does the company have joint control? And remember, in determining joint control, the joint arrangement needs to be determined according to IFRS 11. because with joint control, it can either be a joint venture, which is equity accounted for according to IAS 28, or it can be a joint operation, which IFRS 11 is applicable. If not, then ask yourself, does the company have significant influence? If it does have significant influence, then it will be an associate, which is equity accounted for. Please take note that joint ventures and associates, you apply IAS 28 on both of them. With joint operation, it is IFRS 11. If the company does not have significant influence, that would mean it's an equity investment, which is governed by IFRS 9. Thank you. I hope that has helped. Thank you.